Hey there, everyone. Welcome to Chart This with Dave Keller. It's Thursday, December 19th, 2024. I'm your host, Dave Keller, coming to you from a actually comfortably not too hot, not too cold, Goldilocks sort of temperature, Redmond, Washington. Hope you guys are all doing well. Welcome to the day after. Yesterday's show was all about just scrambling to get our heads around the deterioration that we saw through the course of the market day. Today is sort of picking up the pieces of yesterday and sort of figuring out what's next. And what you'll find as we go through some of the charts together is, we opened a bit higher than yesterday's close, pretty much sideways through much of the day, but going into the close, ended up pushing the S&P and the NASDAQ just slightly into the red. If you're just tuning in, that's because I have dramatically cut down my 60-second intro countdown. I'd had plenty enough of the feedback saying, can you lighten up on the countdown? So, hey, if you guys promise to be on time, I will promise to keep that down to around 12 seconds, which is what the new one measures in on, with some great jazz trumpet featured as well. So thanks for joining me here every market day after the close. Super excited at what we've been able to do just starting the show a couple months ago. Very excited to continue it on and keep making it better than ever in the year forward. All right, let's look at the markets. As you know, we usually recap the market environment and focus on what we learned today. And as a reminder, right, I often get questions about time frame and how you get away from the noise of the markets, as much as we focus on day-to-day price action on a day like today. And on the show, because it's a market recap show, I want to update you on what happened. But for me, it's always through the lens of how does this impact the bigger picture? And so I would encourage you, don't get drawn into one day, right? Yesterday was a big down day, but it was one day. And a lot of charts do not look great at the moment, but a lot of charts actually still look fine, right? Well, look at Amazon, which is still not a bad chart, even with a big red candle on yesterday's session. So try to separate the short-term information that we're sharing here on the show with the long-term takeaways that I hope we were able to help you connect. And that's, I hope the goal of our discussion here every day after the close. Mixed results a little, but by the end of the day, this was a big sort of unchanged kind of day, which kind of makes sense to me. We talked about, of course, we talked yesterday. I said one of two things is going to happen. We'll either get a lot more distribution, but don't be surprised if we get sort of a nice upside reversal day. It felt like we were going to do that at the open, right? When we opened higher, it felt, okay, maybe we're going to get a nice sort of recovery bounce after the sell-off yesterday. I will tell you, if there's any, I guess, takeaway from today, besides the fact that the indexes were flat, is that the indexes didn't really recover a whole lot. So yesterday's distribution kind of holding, right? And I think that tells you maybe the lack of buyers, right? You didn't have a bunch of dip buyers coming in, popping the S&P back above 6,000. We're sort of treading water in this new normal with the S&P closing around 58.67. That's only 5 S&P points away from yesterday's close, and that leaves the S&P around 67 and change for tomorrow. The NASDAQ composite, or going into tomorrow, the NASDAQ composite down 0.1%. The Dow was slightly higher, but again, none of these are big numbers. This was basically a market licking its wounds after yesterday's sell-off. The VIX definitely in the red, down about 3.5 points to 24. So still pretty elevated here. And, VIX above 20 for me is kind of a danger sign. When we looked at deep history with some of my guests on the podcast and in previous shows that I've done, VIX above 28 to 30 was sort of the level that people talked about as being this is now in a very small observation of very high volatility events. We're sort of in that elevated volatility. We're no longer in a low volatility bull market. We're now in at best, a high volatility bull market. At worst, a high volatility corrective period, and maybe somewhere in the middle. By the way, on my YouTube channel last week, I did a choose your own adventure style video where we talked about 4 different future paths for the NASDAQ 100, the super bullish, kind of bearish, and super bearish. I would encourage you to review that if you did not watch it last week. Now that we've had a big distribution day and all of a sudden we've, I think, woken up to the fact that the markets can, in fact, go down, maybe watch that again and think about some of those different potential scenarios going into the end of January. You watch that video and then make your vote, see what other people voted as well. It's kind of interesting to see. Interest rates, particularly on the long end of the curve, continuing to move higher. So the yield curve is getting more and more normalized over time. That tends to have some ripple effects to different things. I wrote an article earlier today for CNBC Pro talking about Visa And as an example of a stock that's actually holding up quite well, even though the markets overall have sold off this week. And some financial stocks, if not a lot of them, can be placed on a more normal shaped yield curve. It tends to be a sector that does better when you have that normal shape, because that's really defines the business, particularly for a lot of regional banks. So the short end of the curve is remaining pretty low. This is where the Fed was lowering rates earlier this week. The longer end of the curve, 5, 10, and 30-year points, all drifting higher. The 10-year yield currently at the close. The bond markets close at 3 p.m. Eastern, in case you weren't aware. So the 10-year yield finishing just below 4.6%, 30-year yield around 4.75%, around 4.75. So bond prices down today. Again, the TLT in a downtrend. The dollar index pushing higher. And as I'm looking at this, I just recorded an interview earlier today, our latest episode of the Market Misbehavior podcast with Chris Vermeulen of thetechnicaltraders.com. Chris is awesome. He's a fantastic technical analyst based in the Toronto area. He's an author. He wrote a book called Asset Revesting, which was published last year. And we talked about trend following. We talked about tracking asset flows, and we particularly talked about bonds and the dollar, all from a technical perspective relative to stocks and commodities and other things. I would encourage you to check that out. Should come out later this evening, I would guess, Eastern time, once we get it all edited up and sent around. But particularly thinking about this page of bonds, interest rates, commodities, and the dollar makes me think of that conversation here with Chris. Gold actually holding steady. It was sort of above and below the zero line, even though silver prices were down a lot more. So sort of a spread between gold prices and silver. They often move kind of in similar ways, but today not the case. The chart of gold is still kind of holding up there. If I had to pick, is it overall constructive or not? I'd probably say more on the bearish side, given the momentum shift that we've observed. We did grab the chart of the GLD, which we'll look at here in a short while, and you'll see what I mean. But crude oil prices continuing to show weakness. Crude oil did open higher, but through the course of the day really drifted lower. We're seeing more and more red on cryptocurrencies, and Ether prices down around 3,400. That's down from a test of 4,000 within the last month. Bitcoin now around 97,000. That's after getting to 108,000 or so in the last week and over the weekend. So you're definitely seeing a risk-off move continued in the cryptocurrency space. If you've ever thought stocks and cryptos are totally different and cryptocurrencies aren't a risk asset, I would wholeheartedly disagree, because I think what you've seen this week is a risk-off move in stocks and a complementary risk-off move in cryptocurrencies. So they certainly seem like for me, I think it's all speculation. So when speculative pressures are lightening up, when investors are getting less, have a lower risk appetite or getting more risk averse, getting a little more nervous about market uncertainty, I'm going to guess that doesn't mean they're buying a bunch of Bitcoin and Ethereum and Litecoin. I'm betting they're probably unwinding positions. And that's certainly what the charts are telling us is actually going on. Looking at the 11 S&P sectors, we can see only 3 of them in the green. Now that's an improvement from yesterday when 0 were in the green. So we're making progress on the upside, but utilities, financials, technology, the only 3 sectors making a positive move today. Now the utilities one at the top of the list is an interesting one. I did grab a chart of the relative performance of some of those defensive sectors. Not really that impressive just yet, but I think that is arguably one of the more important charts to be watching between now and going into the beginning of next year. Because if the markets experience a 2022-like rotation, right? 2021 was incredibly strong. The moment the calendar was flipped to 2022, everything changed. The dollar started spiking, commodity prices came off, equity prices came off, bonds sold off, kind of everything was going down except for the US dollar. But one particular area of note was an improvement in the relative performance of defensive sectors. That was one of the things that actually did improve along with the dollar. And so that's something to watch. It's not quite there yet, but I think that's an important chart to watch here in the next couple of weeks for sure. On the downside, real estate, your worst performer, down 1.7%. Materials down 1.1%, and energy, number 3, down 0.9%. Energy is a play in crude oil. I don't know if you've looked at the chart of crude oil. We haven't featured in a while because it's a pretty boring chart, to be honest with you all. Other things are kind of really working, like stocks. Other things are really not working, like some other stocks. Crude oil, while generally in a downtrend, it's not breaking down a whole lot. It's kind of just chopping around, making noise, but no real progress one way or the other. As a note, of course, I don't formally update my market trend model until Friday's close. So we got another trading session to think about, and barring some huge rally in equities, which is possible, certainly on Friday's session, much more likely as we sort of end the week around a current sort of vibe, which would mean the short-term model would turn negative for me, and that I think that's the 5th time in 2024 when that has happened. The medium-term model for me is kind of the most important one. That's the main one that I use to sort of manage risk in a portfolio. So medium-term models bullish, that means conditions are still okay. Medium-term model bearish means I want to focus more on capital preservation than capital growth, meaning I'm much less excited about adding a bunch of new long positions. I'm just looking to unwind positions and minimize downside in the portfolio if there's downside in the market. So for now, looks like we're holding steady. A huge sell-off could trigger that, but that's probably unlikely at this point. Finishing off our market recap, let's look at the Magnificent Seven and Friends, or these mega cap growth names. You can see Netflix and Nvidia having decent days, up 1.4%. Amazon pretty close, up 1.3%. A couple of these were down. Tesla's down, again, not much though. Tesla down less than 1%. Meta down about 0.25%. Microsoft just slightly below zero. Alphabet slightly higher. So, some of these kind of bouncing after yesterday's distribution. A chart like Nvidia is still below the lower end of that range that we've been talking about. So I still see that as a broken chart at this point until proven otherwise. But that's where the charts played out through the course of the day. All right, let's go to the market recap. And as we do so, or the market carpet, that is, I can see questions you're putting on any of the different platforms you're watching. And we're live streaming on X, on YouTube, on LinkedIn, on Facebook. And I appreciate you so much if you're tuning in live on any of those platforms. I can see questions that you're putting in as we go through the live stream. So if you have a question that comes up as we're going along, pop it in the comments section of any of those platforms. I can see them all here, and I'll take a question or two before we wrap the live stream. Anything we don't get to could be featured in our all mailbag episode that'll be on tomorrow on Friday's show. Looking at the market carpet, again, sort of first thing we do is look at the overall impressions. If you watched yesterday's show, I mean, everything was red, almost the entire thing. It was a big red quilt of stocks going down in a pretty major way. Today, a little more mixed, right? I wouldn't say this is a bullish day. And one of the scenarios on the day after a big sell-off is you have a big counter trend rally, a bunch of things sold off. They don't regain all of the losses, but at least they have a nice sort of dead cat bounce, which is what we often think of that is. This is not what the market carpet looks like today. This looks like a market that's limping toward the weekend and just trying to get the the clock to run out so they can have a weekend to sort of debrief. It's kind of like when your team is struggling in the first half and you just want to get to halftime just to sort of cut your losses, just kind of hold on for a bit, try to reset. I feel like that's what the market was doing today. We just needed the closing bell pretty quick. So overall, I mean, right, mix. I mean, a little bit of green, a little bit of red. It's more kind of in those neutral shades. Some things moving more significantly, which we'll highlight in a moment. But overall, this is very much a mixed day for stocks. Question 2, what about the biggest names, the largest names that have the biggest weights in the benchmarks? Certainly NVIDIA and Amazon stand out as having a pretty decent update, Netflix as well. I would also say within technology, some of the names like Oracle and IBM had a better than average kind of rebound. But the largest names, again, not big counter trend moves. And I think, again, that's the biggest risk to this market. It's not some random, REIT like AMT or Welltower or NextEra Energy or Delta Airlines breaking down. I mean, although, that has its own issues, I would say the real risk to this market is the largest names don't recover, right? They sort of struggle for a protracted period of time. This market has been held up certainly post-election by the strength in the Magnificent Seven. If that strength is no longer there, if the generals are no longer making the progress that you need, there's just a limited upside for this market, and I think that's the danger here. So I will certainly be watching some of these largest names. I would not be surprised. I mean, sort of my base case after what we saw yesterday, my base case between now and sort of early January is that the largest names probably hold up pretty well, because if I'm a money manager and I'm going into year end, I probably want to show my portfolio filled with Meta and Amazon and all those names that have been doing so remarkably well and have really dominated returns in 2024. I'm certainly probably going to want to own those when I get a snapshot of my portfolio at year end, and I'm sure others will as well. So I wouldn't be surprised if those don't break down a ton. The real risk to this market happens in January when that's no longer an issue. Now it's just what bets are money managers making now that you've got 12 months to figure it out, or at least 3 months till your next snapshot. And that's when things could get kind of interesting. Question 3: any sort of opportunistic, smaller ideas to think about? I'm immediately drawn to some of the larger movements that you see within the technology sector. ACN is an interesting one. Accenture up about 7% today. It's not quite breaking out. We need to get above like 375 to clear that high from mid-October, but I like the fact that it's actually moving in the right direction. And again, on a day like today, when the markets were sort of flat, any outliers could be an interesting message, right? Anything that was able to pop when the markets were flat, anything that really sold off, that tells you that it's not a market specific move, right? Sometimes things just move because the markets overall are moving and people are just adding or subtracting risk. But on a day like today, any big bright green or red means there's something going on with that group or that stock, because it's really diverging from the performance of the benchmarks. I'm also drawn to a lot of bright red that you see in here. Charts like SolarEdge, some of the renewable energy names that have been, some of the worst charts around, continuing to be weak. I'm also noting Western Digital down around 60. That's down over 6%. Applied Materials down nearing 160. That's making a new, almost a new annual low, but a new 3-month low for sure. Micron, which was one of our earnings names this week, down 16%. Lam Research down 5%. So, the semiconductor recovery you might have been hoping for certainly did not materialize there. I think that's it. The other thing I would say is just some of these random names that have sort of moved around. I'm definitely noting the lack of a bounce in things like energy. These are some of the sectors that have been a little weaker, to a lot weaker, and really not recovering in any way. You're not really seeing a big dramatic improvement, although utilities, certainly, if I had to grade which sectors are the least bad today, utilities and financials probably come to mind as I'm glancing around the list here. And I would note things like Visa, as I mentioned. I just wrote an article on earlier in the day for CNBC Pro on that one. I think that's an interesting space, along with the other payment processors, PayPal, MasterCard. They're pulling back, but overall the primary trend's still higher. FactSet up 3.5%. This is a market data platform, competes with like Bloomberg and Reuters, Icon, and others, pushing back above 480. So some interesting movements underneath the hood. I think that's where you need to focus if you're looking for opportunities in your portfolio today. All right. Let us continue on looking at the chart review. Again, I can't see your questions. I see a number of them coming in, and thanks so much. I'm happy to answer a couple questions as we continue. Daily chart of the S&P, it's, today was not the big dead cat bounce day that I think was definitely a possibility. One of the scenarios after a day like yesterday, when you have a huge sell-off, is we go so strongly to the downside that a bunch of people wake up today and say, perfect, S&P at a huge discount. It was at 60.50 yesterday. Now we're down around, 58.50. This is a great opportunity to buy, great companies at a discount. Boy, did that not happen today. We saw further distribution through the course of the day. And I would say the fact that we closed near the lows of the day sort of tell me, at least for now, you're not seeing those dip buyers come in. That tells me the likelihood of us breaking below 58.50 pretty real. That's our line in the sand. We're not there yet. We're really close. We're one slightly down day tomorrow away from breaking that. And again, we talked about the Hindenburg-Omen in depth earlier this week. I think that was on Tuesday into Wednesday. And Monday into Tuesday, I believe, we talked about, the line in the sand and sort of holding that support. I could see the argument for a pretty rough beginning to the new year. And that's kind of my base case that I'm working through, just given the similarities between now and December of 2021, which went into 2022, which was pretty rough. I'm seeing a lot of similar conditions right about now. So having said that, what you wait for is the charts to tell you that the trend is reversing, right? I'm a big fan of following trends, which means until the trend breaks, I'm going to want to own stocks. So I still own plenty of equities in my portfolios. I still have plenty of exposure to the markets going higher. But we break below S&P 58.50, and I would certainly start to at least rethink a bit of that in the short term. Market trend model, medium term time frame goes below zero. That would be a real dangerous sign as well. But we did remain below the 50-day moving average today. Other charts I want to highlight for you, some macro charts just to throw around. Interest rates, particularly the longer end of the curve, continuing to go higher. I've been asked like what that means. I mean, there are different reasons why rates move up and down. To be honest with you, the general thinking with something like this, what right now we're seeing the dollar move higher, we're seeing interest rates move higher. I think that's partly an expectation that it's partly the Fed lightening up on rate cuts. I think part of that is concerns about inflation with the Trump administration and some potentially inflationary policy decisions that they've been, certainly floating around going into the elections. I think all of that is helping to make the longer end of the curve start to go up quite a bit. So the 10-year yield is going up, and I'll tell you one area of the market that I immediately think there's some, there are a lot of relationships that can be difficult to sort of triangulate, right? This is not a simple comparison. It's not like if rates go up, XYZ happens to all these other things. It's not that simple. It's a little more of a complex machine. But when rates go up like this, I immediately think, boy, home builders cannot be a great bet at the moment because houses are just getting more expensive every time the 10-year yield ticks up about 0.1%. I just feel like someone going for their mortgage and being blown away by what their payment's going to be and how much more expensive that is from 3 months ago in mid-September when the 10-year yield's at 3.6%, or about a full percent higher. It makes a real difference in your monthly mortgage payment depending on what you're doing. So that is not a great sign, certainly for home builders in particular, but other things that are tied to rates as well. Did want to highlight the breadth conditions. I mean, I think we've covered this pretty well, that breadth conditions have been getting worse. Certainly in the month of December, we've seen an acceleration in that. I mean, the advanced decline lines, which I'm showing you here, all made new all-time highs right around Thanksgiving, certainly going into that final week in November. All 4 of them have come down. All 4 of them have now broken below their 50-day moving average. For all 4 of them, the 50-day moving average is at least flat and maybe slightly trending downward. And now all 4 of them, I am color coding them red because they've all made a new monthly low. And so that tells me that the trend in breadth is definitely negative. This is a sign of a broad distributive pattern, which again, the market can go up in these conditions, but highly unlikely. It's sort of, the way I would think about this, think of this as whether, again, I hate to hammer away with football analogies, but we are getting to the college football playoffs. My Buckeyes playing the Tennessee Volunteers on Saturday. I'm a little focused on that game for sure. However, I would tell you that, think of it as, is the offense on the field or the defense on the field? When the advanced decline lines are trending down like that, it basically means the defense is on the field. Now, can you score when the defense is on the field? You can. You can get a pick six. You can intercept. You can, cause a fumble. There are a lot of things you can do to get the ball back and at least set yourself up for a new momentum shift to more offense and chance of getting some points on the other end of the field. But, it's much more likely you're going to score when you have the offense on the field. So the advanced decline line's all trending higher. That means you have the ball, you're making progress, things are good. The defense is now on the field. So it doesn't mean we can't score. It doesn't mean that there might be some dramatic reversal, but it's just a lot less likely. And I think that's something we need to remember. As a reminder, a lot of the sentiment data is updated Wednesday into Thursday. So Thursday midday, usually get the updated prints on things like the AAII survey. Just a quick update there to tell you that we are currently, 41%. That's not much of a change from last week in terms of the bulls. It was up to around almost 50% 2 weeks ago. That was the first reading in December. Now, mid-December, we're down around 41%. That's still pretty high, right? And the bears have not changed at all. So even though the market was pushing to new highs, pulling back quite a bit this week, the number of bears not changing at all. Now, a lot of the people probably responded to that survey before the Fed meeting because this usually is locked down on Wednesday. So there might be a timing issue. It could be next week that you would see a big dramatic increase in bears. But for what it's worth, this week's reading, pretty similar to last week. I mean, slightly lower, but not much of a change. The name exposure index, which is the National Association of Active Investment Managers, some money managers, wealth managers, people that manage other people's money, respond to a survey of what their allocation is to equities. This was almost to 100% last week. This week, it's down quite a bit, about almost a 20% drop to 83%. That's one of the bigger drops that we've seen, certainly in 2024. I mean, other times we've had a big drop after being around 100%. Certainly right at the beginning of the year on that pullback in the first week of trading. You certainly saw that going into the April low. You saw that in July, right at that July peak. So we're sort of seeing similar conditions to some of those previous peaks. The problem is this indicator can go much, much lower. And in declines, in protracted declines, you can actually see it get down to even single digits or so. So there is plenty of downside to be had on something like this. All right. I did want to highlight, I mean, what happens when a market sells off so aggressively is sometimes breadth indicators and other measures of momentum can get so bad, all of a sudden they start to look good. I did want to highlight, there's, around 20% of S&P stocks above their 50-day moving average. That's down from around 80 some percent at the end of September. Here we're looking at the bullish percent index for the NASDAQ 100. So out of those 100 stocks, what percent of them have registered a bullish signal most recently in their point and figure chart? About a week ago, that's around 70%. Today, that's around 38%, which means, quite a few, 30%, about a third of the NASDAQ 100 names have registered a sell signal just in the last couple of days. So it's certainly, it's certainly an initial salvo on the downside. But when this indicator gets down to 30%, the bullish percent index on the S&P is what I usually use to navigate tops because I found it signals pretty well there. The NASDAQ 100's bullish percent index I actually often use for buy signals. When it gets down to around 30%, even gets slightly below there, once it gets above 30%, that usually ends up being a pretty good buy signal. Last couple of times we've been down or below, down to 30% or slightly below was at the August low, which is here, at the April low, which is here, and at the October 23 low. So if this indicator gets down to 30%, it can certainly go lower than that. But I would immediately be looking for an exit above that 30% level for at least a tradable bottom to be found. So some of these breadth indicators, again, worth watching because a contrarian buy signal could certainly pop up. As I mentioned, defensive sectors are important to watch because, again, spending a lot of years with institutions, you have to be fully invested, right? So if you manage a mutual fund and you're benchmarked to the S&P 500, you have to own stocks all the time. You can't have a lot of cash in your portfolio. That's part of your mandate. So what do you do if you're really nervous? Well, you get into defensive positions, you get into lower volatility names because the idea is they'll probably go down a lot less than the markets. You try to gather income through dividends or something. You try to be in areas of the market that are going to perform better on a relative basis. You're probably going to lose money owning equities if the market goes down a lot. But you can try to lose less than the S&P 500. That's sort of your goal. So you often would rotate to one of these sectors or a mix of them, right? Utilities, consumer staples, and real estate. These charts are showing the relative performance of those sectors. You can see like utilities popping up a little bit, but overall these sectors are not improving to the degree that I would say, wow, it's a huge rotation to defensive positioning. And that's why a day like we saw yesterday is sort of just an initial move coming off of all-time highs. We're not seeing like a big defensive rotation, big sell-off positioning yet. I'm seeing still, more offense rather than defense. And the ratio of the XLY to the XLP, consumer discretionary to consumer staples, still very much favoring consumer discretionary at this point. Let's talk about gold and Bitcoin. I've got a couple stocks, and then I'll take a question or two, and we'll be all done. Looking at the gold, GLD here, I want to highlight, it hasn't really broken down a whole lot. I mean, the chart of gold is certainly not going up anymore. And I think similar to the chart of NVIDIA, I think you think of this chart probably as going that third direction. It's not really going up anymore. It's not really going down. It's going sideways. And so when you have that, you sort of identify that range with NVIDIA's 150 and 132 that we talked about. Here, I would say the GLD, it's 250 on the upper end, which is the this gap period over here and the highs from November and December. And then on the downside, I'm keying into that low from mid-November. That's right around 236 or so. So I think at some point, we either go below the lower end or above the upper end of that range. And I think that will tell us a lot about what's going to come next, most likely for gold. I think an argument to the downside is the fact that the momentum picture is overall not very, very good. The RSI has been consistently in a bullish range for almost all of 2024 until the second week in November, when all of a sudden we start to push lower. And now on rallies, the RSI is stalling out at 60, which is more consistent with a bearish market where the whole range on the RSI starts to drift lower. So if you asked me to say, you have to pick up or down from here, I'd probably say more likely the gold goes further down until proven otherwise, because I think the momentum is more negative, and I think we've already broken below moving averages. We're not really able to regain them. So I think that's sorely an argument there. If I had the option for sort of a neutral, I would be neutral until we break out of that range. I did want to highlight, of course, cryptocurrencies, as I mentioned in the market recap earlier in the show, coming down quite a bit here this week. I'm highlighting Ether, Bitcoin back below 100,000. And again, overall, the long-term chart is still good. I think the problem with Bitcoin is the negative momentum divergence that we've seen, where the price pushed above 100,000 on weaker momentum. That's not great. I think with Ether, it's even more concerning because we're actually still struggling to make a new all-time high. We pushed above 4,000 back in March. We failed to do so again in May, and all of a sudden we're back here at 4,000. We've had a couple tries at getting above that level, but we failed to do so. So this week's pullback is just once again reinforcing why 4,000 is the level. So I think, until and unless Ethereum can get above 4,000, I'm a little skeptical about strength here in the short term. And I think the 50-day moving average is kind of where you might expect a bit of support to be applied. So let's see if we can get a bounce here. If not, we have to talk about further deterioration. 3,000 or so will be probably my next downside objective, given a break about below current levels around 3,300 or so. And I should mention of the things we've talked about: Ethereum, Bitcoin, GLD. I don't own the SPY or anything, but I own plenty of things that are kind of like that I'd say that's a fair disclosure anyways. Oh yeah, here's the chart of Bitcoin. I thought I'd included that, but I forget. I put them in reverse, and I thought, so here's the bearish divergence I was mentioning, right? Bitcoin going higher mid-November to now mid-December on weaker momentum, right? So as we're really trying to make gains above 100,000, the RSI is not even pushing above 70. So that tells me, that sort of implies the car's running out of gas here as we're sort of making that last push to the upside. So again, some of these could be vulnerable if we see a little bit of weaker momentum here in the days to come. Finally, a couple charts, and just a reminder. I mean, as much as you might be worried after what we saw yesterday, let's remember that Amazon made a new all-time high 3 sessions ago. We're still not that far off of all-time highs. This chart is still very good. We're making higher highs and higher lows. Pullbacks happen. Even in the most bullish of bull markets, you're going to have down days, right? And some of the biggest down days happen in bull markets. Some of the biggest up days happen in bear markets. So remembering to take a step back and reflect on the overall trend is important. I mean, I would not be surprised if Amazon deteriorates beyond what we've seen so far, but I don't see enough yet to be really concerned about a position like that. Charts like Micron, though, boy, talk about underwhelming follow through on an earnings day. This is a company reporting earnings yesterday. Semiconductor space obviously has been one of the weaker parts of the technology sector. We can see that resistance around 115 that happened in September and October and November. We reapproached that level. We failed to close above the 200-day moving average this week. Now we're gapping down and testing 85. Now 85's potential support. So I'm not surprised we gap down exactly to that level. That's where I have an alert set. We didn't quite trigger it today, but I think breaking below 85, and that unlocks the potential to go much further down. So the line in the sand technique means identify line in the sand. 85 is it for me. We break that. It's a broken chart, and you really probably want to avoid it. For now, it's just a stock that is unable to regain its mojo in a group, semiconductors, that have been unable to regain their mojo as well. All right, let's get a couple questions. Yeah, I get some support about ditching the countdown. You're welcome. I heard you. Just had to figure out how to improve that, but that's the key. Let's see. Jay, thanks for watching on YouTube. He said volume is down in the holidays. Do you think this is normal? May this have more impact now? No, really good question, right? And as you probably know, if you've watched the show for a while, I don't cover volume a ton, but I certainly do to some degree. When we do talk about volume, I more often talk about things like the Chaikin money flow or accumulation distribution, or one of those kind of indicators that looks more at trends in volume than looking at individual days volume. I think I can buy more of that sort of mentality more than anything. What? So what does it mean? Yeah, I mean, so generally speaking, you have to sort of remember that volume tends to be lighter around the holidays. I mean, between now and year end, now that the Fed meeting is behind us, there's not a lot of more news flow most likely to come in. This is sort of that quiet period until the beginning of the new year. So generally speaking, the markets tend to be lighter volume. They tend to be drifting higher a bit because of year-end window dressing. So things that have done really well usually don't sell off aggressively, usually because money managers want to own those names. And so there's sort of that last flow back into those top performers of the year. That sort of solidifies their place on the leaderboard. January is when things sort of reheat up again. So, I don't want to say that there's nothing to be gained from analyzing the markets. I think for sure, especially now that we've shown some periods of vulnerability, I wouldn't be surprised if this is a bit different than average because of the week that we've had and the day that we had yesterday. Having said that, yeah, volume, I wouldn't pay a ton of attention to volume, only because it tends to be lighter normally. So if there's lighter volume on a move, I don't know if I would read that much into it right about now. Thanks for asking about that. Richard, you asked, will you purchase puts or sell calls to hedge your portfolio against further volatility? So, and thanks for asking about that. So personally, I will do neither of those. That's just me. I don't trade options, and the issue I have, and I get the argument for options. I've talked to so many options experts. And again, I get the value of them. And if you use them in your portfolios, I don't blame you. And I think that's a great opportunity for individual investors. If you understand the structures and understand the risks, it just gives you a lot more possibilities and levers that you can pull. My own investment strategy, I designed it at a time when I was, behind a bunch of compliance walls, and I was very restricted in terms of what I could actually do in my own portfolio. So I had to develop an approach that did not involve options or derivatives or hedging or any of those kind of really fun things that kind of make a period like this a little more easy to manage. I can have that. So what do I do? So I would say, yeah, I do use inverse leveraged ETFs on a limited basis if I'm planning on a bit of a downside move. Other than that, I rotate out of high beta stocks, and I rotate into more defensive positions. And whether that's commodities like gold, hard assets, other things. I mean, in general, it's going to be the charts that are working. So if stocks aren't working, I'll rotate into charts that actually are going up, and something somewhere is going up at all times. That's one thing that I've definitely learned, and I hope through the course of this show we were able to help you find some of those opportunities as well. Folks, that's it for today. I want to thank you guys so much for joining me every weekday after the close, especially as we navigate these weeks. I mean, I hope you can pick up on the fact that I really enjoy doing this. I love following the markets. I love analyzing charts. I certainly don't have a problem talking about them, and I enjoy doing so. And if stuff that we've done this week and this year has helped you navigate these markets, I'm very thankful for that. Hope you will continue to join us as we wrap up the year and move on to a hopefully very successful 2025. But between now and then, remember, it's always a good time to own good charts. All mailbag episode coming tomorrow. Have a good night.